All right, so what we're talking about today is the swing trend channel indicator. It is designed for capitalizing on trending markets, looking for initial entries and for identifying re-entries into a trending move. Designed by a trader called Jake Bernstein, and I've adapted it with a couple other filtering techniques and implementation to like make it suit sort of my trading style and to sort of weed out some of the weed out some of the unreliable signals created by the method. It has a few components. Right now, we're looking at the script that you all have access to. There is another one that'll be coming out like a little bit, like in just a little while, not like today or tomorrow, but like pretty soon. I'm still working on coding out some of its properties. The primary elements of the script are this moving average channel because it's created by two different moving averages, a 10 period simple moving average of highs and an 8 period simple moving average of lows. The two moving averages will never ever cross unless you have like really shitty data, or like a very illiquid token that has like really wild swings, like where it'll be like stagnant for a while, and then you have like this huge swing. Then you'll sometimes get instances of like the moving averages being at the same value or crossing or weird stuff. But for the most part, they will always be separated. The moving average channel is essentially designed to identify bullish and bearish trends. There's a combination of factors that are used to identify the trend and like clarify what the trend is, and that's using candle position in relation to the channel. Like the first element of that is like indicated by the little dot right now currently in the script. Like that's indicating the first like condition being valid, and that's two complete candles above the moving average channel. So like this is the first condition to identifying a bullish or a bearish trend. The second condition required to identify a trend is not written into the script. Well, excuse me, it's not visible in the script, but it's using another indicator called the Williams accumulation and distribution. That's a fancy word for just looking at how prices are moving over a specific period of time. The traditional indicator, accumulation and distribution, is looking at volume, where Williams accumulation and distribution is just looking at price action. So the actual combination that you need for defining a bullish trend is two candles fully above the moving average channel and Williams accumulation above the moving average of Williams accumulation. This part is not necessary to really understand or know. It's just back end stuff that's like it's just part of the like algorithm. So you don't necessarily need to know anything about Williams or how it works. It's just kind of an extra bit of confirmation. So 2 bars above the channel, Williams above the moving average would essentially qualify this candle from this point in time as a bullish trend, and prices continue on moving up, and we want to know like how to get into this move if we missed it, and that is what the moving average channel is for. Typically, if you go like back in history, during bullish trends, like a moving average of lows often will act as support. So you're identifying a trend, waiting for price to come to the support, and then you're entering into the trend like to capitalize on the bounce back up. So like the execution on this particular strategy is really just waiting for a trending signal, and then for price to come to the support, enter, and then exit at your resistance. So in longs, the blue is your support, the 8 period moving average of the lows, like the lower band is your support, and in short trades, Like over here, we have a short trend signaled here. So in shorts, that top band, the 10 period moving average of highs is your support. So like you'd be entering when prices come up to the support for your short. Like you're waiting until prices come up to the top band, enter into your short, and then you're taking profit down at the lower edge of the band. So like this particular strategy is really just about like patience and waiting for prices to come to you. So that's really the bare bones part of the strategy. Like you have the identification of the trend, and then we have like this other flag symbol right there. This is brought into the picture when there are 5 consecutive candles above the moving average channel. This is the ideal scenario that we want. 5 candles illustrating a strong trend, and then you're entering in after prices have retraced. So 5 candles above the moving average channel, prices enter support, enter your trade, then exit at the top of the band. Like there are plenty of times, like there's other implementations that we can go into later, where once you're in a trend, like once you've defined a trend, when prices are moving back and forth in the band, these are alternate entry points that you could have. So you have like your first entry there, your first exit there. You can have another entry here, another exit there, another entry like right there, and another exit right there. So like once you're in the trend, you can play bounces with like inside the band or inside the bands, but like ideally you're just like using this swing method, like waiting for price to go up, identify your ideal condition, enter, exit. It's just like this type of playing is just a higher, like more advanced level of execution. So that is really the basics of the strategy. Wait for your 5, your like indication of 5 strong candles above, or not strong, but 5 candles above the moving average channel, into your short or into your long support, exit your short at the top of the band. That's like really just the basics of it. The filtering that I've added into the method that is not the baseline is utilizing the CMO, the script that I wrote out. It's called the ACT, the Absolute CMO Trend. The CMO is Chon Momentum Oscillator. It's really similar to the RSI or momentum. It's just like a momentum based indicator, but it's using the absolute value, meaning there's no negative or positive. It's just like a flat, or excuse me, there's no negative values. It's just like an indexed 0 to 100. And what it is measuring is what it's telling you is like if there is trending price action or less, like not so much trending price action, ideally we're wanting to enter these swing trades when you have a defined like trend, and going back through like history, like and doing back testing and things like that. Its values, like the CMO, when its values above 30 are typically correlating with strong trending action. So like ideally when I get to my entry point, like when price comes towards my entry point, I want the CMO to be above that 30 level, because that's suggesting that there's still the presence of a trend. And since the CMO is using absolute values, like where there is no negative values, it can't tell you whether the trend is bullish or bearish. It can just tell you if there is or isn't a trend. So what you're really paying attention to is just being above the 30 or not. So like mathematically being over the 30, like there should still be the presence of trending price action. This particular entry here would have been fine to enter at the bottom of the band because our CMO is still registering above 30 and that hit its target like the next day. Same thing here. This one, your entry is right there. Our CMO was still above 30, so like it's fine to enter into the trade there. It took a little bit longer, like 2 days, but it still hit the target, following that. And then the CMO started registering below that 30 level, and you can see that price action just like set flat, like there was no real trend anymore at that point in time. So these are kind of the 2 indicators that you'll be using together. Like you're using the baseline, which is your STC, the swing trend channel script, and then your filter is the ACT. You're using this to like guide you on whether you should take the swing trade or not. So ideally, your like the initial methodology is using two targets. You have your first target being the top of the channel, and your second target being 2 times whatever the channel width was at your entry. So like, let's say that we can measure real quick. Like the candle here to up there was $826. So essentially you're adding 1,652 to this entry price, and that will be your second target. So like it hit the first target here, we'd exit half of the position, moving to either a trailing or a break-even stop, and then our second target, would be like up here somewhere, and that got hit like right up there because it never came back to like our entry position during that time. That implementation is fine. You can either do the 2 times the width of the channel at entry, or you can just do like initially just go on to a trailing stop at that point in time and not worry about the second target, or you can just exit out fully at the top of the band. I've sort of moved towards that route of exiting at the top of the band, or if I'm in a short, exiting at the bottom of the band, and just waiting for another particular entry. But it's really kind of at user's discretion of how you're wanting to trail or exit. But really, you need to have that the band top being your first way to de-risk yourself out of the trade, at least, like at a minimum. No, I can't hear. I'm looking at chat real quick. Chris, I cannot hear you. No, entry is when price is touching the band. This is not entering after close. It's just immediate. Because like sometimes, let me see if I can find an example. When you have really volatile moves, sometimes you can hit your target like in the same candle. So if you're waiting for close, like you might not get your entry. So you're just entering down as soon as price is hitting the band, as long as your ACT is showing like a trend. Still, I can't find an example of hitting one in the same candle, but it does happen. All right, here we go. You had the short trend confirmed there, 5 bars below the channel. So you're waiting for price to hit the top band, and we can't really tell because we don't know how far price went down, but it's very possible that during this candle, price wicked up, hit that, and then wicked back down, and then closed right there. Like this could have had your entry and exit all in the same candle. We just don't know. No, I don't think you need to use I don't think it's necessary to have Williams accumulation and distribution on the chart because it's baked into the script. And like seeing this doesn't really make any difference to like what's going on the chart. Like this is just like a check in the box sort of thing, and that check in the box is written into the script. Like it's not going to tell you that there's a trend unless this has been fulfilled, and if it hasn't been fulfilled, like you don't need to be doing anything anyways. So like you don't need to worry about that so much.
When we're using the STC in combination with ACT, is there a condition where, or could there be a condition where the STC would, suggest to enter a trade, but ACT doesn't really support that because it's somewhere, below 30?
Yes, and like this is where this is the same thing. The filtering is used as a discretionary measure. It's just like having the RSI set up on the CSM. In an ideal world, you will have a CSM signal with the RSI poised to break over the top band. That's creating your perfect condition. You're not always going to have perfect conditions. Like you can take a swing entry with an ACT below 30, but it's a more risky proposition.
Mm-hmm. So wait until it breaks above and the STC condition is given, and then there's a higher probability of like winning that trade.
Yeah, like This method is like one of the more rigid execution strategies that I've ever like dealt with. If your entry condition comes in and the ACT, let me see if I can just find one where you get an entry and the ACT doesn't support it. All right, so here we go. This is a good example. So you have the bullish trend signaled there, you're 5 bars above the channel, entry condition touching the bottom band, and our ACT right now is measuring at 26.36. So like this would be a more risky proposition because like as we're getting to our entry condition, we're showing that we don't have a strong trend. So like in an ideal world, I would not take this trade because like the perfect condition is not there, but it still worked out to being a perfectly good signal and it hit its target like in 2 days. You shouldn't be waiting like this is it. If you didn't get your entry there, like that's done. Like you don't do anything else. Like you're just waiting for another signal. Like it's not advisable to just wait until the CMO pops back above the ACT unless it gives you another entry signal, which it technically did. Like prices came above the bottom channel and then prices moved above the bottom band and they came back and touched the bottom band again. So this could have given you a secondary condition to entry, and the ACT is measuring at 30.03. So like this day would have been fine to enter that swing position and then hit the target the next day. So like right here would have been nothing, but you got another chance to enter because prices came above the channel, touched the channel again and went back up.
And then what would be the my condition for saying exactly for that candle there? Would any of this suggest to actually leave it again, like when it goes below?
What do you
like,
mean?
What's the margin I'm looking for? Like if it goes like really below in a swing?
So the stop. Oh, yeah, I didn't say that. The stop loss is the same as what the secondary target would be, and this is stuff that I'm building into the second script where it's plotting the values for the stop loss. So like every system has like 2 targets that I've been putting out. The first being the top of the band, and the second being 2 times whatever the band was at entry. So your first target would be like the top of the band right there, and then your second target is 2 times whatever the gap is right there. So like your second target would be like around up here, and your stop loss is the same distance as your second target. So like your stop loss would be like a close down there or something like that. So
yeah, so basically 2 times minus TP.
Yeah. It's the same as a CSM where you have like a 0.5, 0.5, and then a 1, and this is the 1. Like the full target is a 1-to-1 ratio. Okay. But we're just concerned about de-risking at 0.5.
Jerry, with the CMO, I know that we've talked about this before. Is the measure between 30 and 60 any indication of strength, or it's literally just a trend? It's
yes.
Like looking at
it is a measure of strength because it is an absolute value, not a relative value. So like when you're looking at like, this is the difference between like the RSI and any measurement that's using the absolute values. Like the RSI is relative strength. So like you can't look at the trend here, the strength of the trend here compared to the strength of the trend here, because like on the RSI, it's relative. So these 2 points would not be equal because they're adjusting to whatever the conditions are at this time, where this is an absolute value. So everything is weighted the same. So like you can say that like this bearish trend right here was not as strong as the bearish trend right there because your values are like way, way, way higher. So like, but even in that, like, it doesn't really matter that like you have a weak trend or a strong trend necessarily for the swing, because like the math overall, like that's why I picked the 30, because overall it's not enough to like not take a trend at a 30, but do take a trend at like a 45. Like it's not really making any difference in the math.
Okay. Okay, I mean, that's fine. And then my next one was understanding, like, I know that again, this is when you first brought it out, we're talking about this is a trending environment indicator, and ideally you want the swing high, swing low, swing high, swing low, making higher highs on a bullish trend, right? And really good ways of getting in. But on the example that you just had, and I know that this is the daily, so maybe my next question under that could help get some more information. But on this one, you had a 5 bars above the channel. So you had your flag, and then it consolidated for a little while, but there were still trends inside. Sorry, there were still trades inside that channel. And then there was another 5 bar trigger. On the daily, understanding that it would take days to get up and down through that channel. When you go down to the lower time frames, even like a 2 hour or 1 hour, I guess it's more risky to try and just say like it's the conditions are met. You have a 5 bar flag, then it consolidates for a little while, but you've still got those trade entries. Would they be worth taking, or on those lower time frames, are you really trying to wait for that higher high, higher low, higher high, higher low trend?
So there's sort of a difference in the terminology here. Like this is looking for basically a mathematical trend, not like a visual pivot point trend sort of thing. So like, yes, you do need higher highs and higher lows for a trend, but like we're just concerned with the math of what trend is, not really like for this exact, structure being broken.
Okay, so then would you say in right where your crosshairs are, moving over to that flag, that's a strong bullish indication?
No, this is just a transition from bearish to bullish trend mathematically.
No, the next one, the flag.
Yes, so this would be, this would be a strong bullish trend,
Looking to the right, you have like some consolidation, but because that indication has happened, would we be more likely for those if you go to 1, 2, 3, 4, 5, 6, 7, 8, 9 candles to the bearish red candle, because of that previous strong bullish indication that is still likely to hit that next swing, essentially, even though it does? I'm just trying to think ahead. Like,
I mean, that's what this method is for. Like it's a swing trading method. You can't have a swing without a retracement. Like a pendulum goes back and forth. You can't have an entry unless you have like prices retracing. This is the math of this is saying that like mathematically the trend is strong enough to withstand some retracement. So like you're looking for a safe place to enter on that retracement. And like this moving average over enough back tests shows that like it can hold up enough to enter into a trade.
Okay, that's cool. So then when would you look at not getting into a trade after the 5 candle, like even moving to the next one? This is a good example of it. Indicates a strong trend. And then is it because the ACT goes down below the 30 that strong bullish trend is not continuing on?
I don't know what you mean, because like this one, like you had your flag signifying like the conditions for a strong trend, and then you get your entry and then it hit the target.
Okay. And so then you would be essentially out of your first TP.
Yes.
And then you would just be looking to see what happens, and then you're like, oh, okay, so shit went south, made my money.
Then I would just be waiting for another bull flag signal to come up, and like that never happened.
Okay. And then when would you look at transitioning to short, for example, when you just have the strong the strong bear flag?
After you have a bullish trend after you have a bearish trend and then a bearish flag. Like it's really just like very systematic. Like don't take any shorts if you're in a bullish trend, and don't take any longs if you're in a bearish trend. And like when you're into a bearish trend, wait for the signal to like tell you it's a strong enough trend to withstand a retracement, then enter, then get out. Like it's very quick, and you shouldn't really be like, the longer you're sitting in a position, like let's say that prices never came up to hit the target here, like the longer you're sitting in a consolidated pattern where price hasn't hit the target, the less likely you are to like hit your target anymore. Like ideally these things are happening like very quickly, and like that's the point of like just waiting for the right signals to come in.
Then what about lower time frames? I know that the system stays the same. I'm not trying to change that. It just happens quicker.
The system stays the same. Well, I mean, yes, because like relatively you're on a smaller time frame. But like the reliability, just like on every trading system, like the smaller time frames you go, the more noise you're going to get, so they'll become a little bit less reliable.
Right.
But even so, like you have the strong flip to a bullish trend, 5 bars above the channel, entry when it touched the bottom channel, hit the target. Another signal here, 5 bars above the channel, hit the bottom band, hit your target either right there or right there. I don't know which one, I can't tell which one it was, but either way,
Yeah.
it still worked out. 5 bars above the channel, entry signal either here or right here, hit the target. 5 bars above the channel, entry there, hit the target.
And so does the thickness of the channel at the time, because obviously sometimes after a strong signal, the channel's quite close together.
Yeah.
Would that dictate the amount of leverage that you use? So if you have a smaller channel, you use a higher leverage so that you can make the equivalent because it's a smaller move.
So you're getting like a little bit ahead.
Okay.
But number one, I'm not gonna say like, yeah, use more leverage, because like that's like something that's gonna get people in trouble. But the width of the channel is a consideration to the risk. Like if you have a smaller channel, that means you have a closer stop loss, which means you can risk a little bit more than you would when you have like this super huge channel, because then you're like having to absorb a lot of risk. So yeah, that's the right question. That's a good question to ask. And yeah, like for smaller channels and smaller positions, you can utilize a bit more capital or put in a little bit more leverage, because you have a little bit lower risk threshold for that trade.
Yeah. Okay.
And that's also something that I haven't built out into the script yet, but I was going to go to. That's these sort of things down here. This one, which no one has access to these two yet. This one right here is showing two things. The histogram, or the columns, are the width of the channel. So like the channel right here is basically $1,600 wide. So like that's what the move is from top to bottom of the channel. And then the moving average is like a 50-day simple moving average of. So like you can sort of see how like on average what you'd be like looking for in a move, about $843 to move from the top to the bottom, like roughly. So like if you have like I was going to build out a scanner similar to like the Momentum Rank screener that like just shows a bunch of assets and shows how far apart the candles are based on like percentages, so you can see where if you're looking for a swing trade, like where you can get like what average percentage you can get off of like a swing on that chart.
And then would the same premise be for what we were just talking about, the CSM? So taking a bullish trend on the daily, if we were looking at 2 or 4 hour bullish swings are more likely to be.
Yes. Like if you have like the higher time frame confluence, so like if you have a bullish trend on the daily chart, your intraday swings like to the bullish side will be more likely. But it's like you may not even get like a bearish trend on like the smaller time frames. Like the smallest ones, like under an hour, yeah, you can probably flip trend. But like anything above an hour, you probably won't. And at the same time, you may not even get entries again. It's like you had this signal and like it never even gave you an entry till way the fuck up here. So like really, like if I was doing a trade on this, or if I was looking to implement a like process of trading this, I would have the signals, or I'd have the symbols that I'm trading regularly. Like, so let's say I'm just trading Bitcoin and Ethereum. I'm going to put an alert on the daily chart trend. So like I'll get alerted when the daily chart is in a bullish trend. And from that, then I'll go and turn on the like intraday time frame that I want to trade. So let's say I'd turn on 20-minute bullish trade alerts. So like it's just telling me every time I get, the 5 bar, or when I get an entry on the 20-minute, and I'll just take each one of those every single time. So like this one hit would have gone in fine. This one hit would have gone fine. And like that's how I'd keep my confluence in line with the higher time frame trend. If I'm on the daily chart, I'll just wait until like I get a weekly bullish trend. So that's like here on the 17th of April. And let's go down to the daily chart, 17th of April. I'm going way too far. April 17th. See, like it didn't even give a daily trend signal until like right here. But like this swing entry would be the fucking baller one to take, because it's going to be that weekly continuation. It's like this weekly one came in you would have been on the weekly time frame, you would have been in at like 26K taking profit at 29, which was in line with all the other stuff that I was doing earlier, but you would have had to like sit in it for a couple weeks, which would have sucked.
Yeah.
But either way, like it still hit its target. And now we're in line with the trend. It's just like not a strong one on the week with like that weekly context, but still like daily and weekly alignment right here on this bull, on this swing entry. So like when we get a pullback, like it'll be the one to take.
Have you tried these on other things other than crypto, like commodities or
every single thing that I have shared can be utilized and works on anything that has a chart, because it's not about like the asset, it's really just math
of the asset? Okay, cool.
Yeah.
On the daily, could you go to, what was it, like March 8th or something like that? Actually, we were just looking at it there. There's a bear signal and then the strong signal, but then it never touches until it's actually a green daily candle. Like, how do you handle this? Like, because if I were to enter here at the yellow, when it touches the yellow part, I'm like, it's going the opposite direction, right?
Well, ideally you wouldn't, because you don't have a strong trend on your filter.
Yeah, that's just the filter. Okay, good.
Yeah, like you get to your entry condition for the short, and it's showing that you don't have a mathematically strong trend. So like I wouldn't want to be entering this one, or if I did enter it, it would be for a smaller position size, because like I'm now discretionally working against like
right. Okay.
Like this before, like this system didn't really have any filter. It was just like take the trades, and like it does work, but it's like the ones that hurt, the ones that don't work really hurt. But this filtering is like amazing, and it keeps you out of a lot of this kind of stuff.
Yeah, because like entering there, like on the first on the yellow one would have been like, okay, I'm fucked. Like,
you'd have been instantly blown out. Yeah.
Like I visited it like at 32K again.
Yeah. And also like in crypto and most things, like any sort of financial asset, honestly, the priority should be longs, because you're going to have more opportunity and potential in longs than you will shorts. So like, yeah, sure, you can take all the short trades that pop up, but your accuracy on almost every system that I've got, like the profitability on longs is a higher percentage than the profitability of shorts. So like really kind of focus on those long trades for the most in financial assets. That's just the nature of like investing.
Yeah. And then just a general question, because when we were trending up a few days ago, like I was doing really, really good, especially with like, scalps and stuff like that. But like every day, like, earlier in the morning, like it sort of set the tone for the rest of the day. And then once we came, like from first to the bottom, it's like this blah market that's just like, like grinding you down, because like there's barely any volume, and if there is, it's just like falls left and right, and you get like taken out like really quick. Is there sort of like a standard thing, like the best time where you want to have sort of like enter your trades for the next 24 hours, if you will? Is it like the 6 o'clock morning thing, or is it the 4 o'clock morning thing?
Well, I mean, that really depends on
your general
system.
question, but like,
yeah.
How do I ask it differently?
That really just depends on the signal. Like, I mean, I'm not going to be like, I wouldn't do stuff just to do stuff. And like, yeah, there may be a more opportune time. Like mornings do have more liquidity, just because like, well, for New York, because like you have the stock market opening during that time. That's just when the most people are like actively trading. So like, yeah, sure, it may work out, but like, that's the time to like enter into your, short or long, like in correlation. But I wouldn't just jump into a trade in the morning just because like there's a lot of volume or like liquidity or something like that. When you act, honestly, in my opinion, just depends on the signal being generated. Like I don't execute without a signal. Like that's just, there's no point. Well, it's not there's no point, but that's a bit extreme. Like it's impossible for me to measure effectiveness based off of like just generalities or assumptions. And like if I can't measure what I'm doing, there's no point in doing it, because how do I get better at something that I can't measure?
Yeah. Okay.
I don't know if that answered your question.
Yeah, no, I mean, like, it makes sense, but like the signals are usually also there in the morning, right? Like when I get to the lab at like 9 o'clock, I was like, oh my god, like we're already past the top, right?
Yeah. I mean, if that's
Going-
what you're finding, that like anecdotally you're seeing that signals are showing up in the morning, then you're just gonna have to adjust and like wake the fuck up and trade in the morning. Or just trade on a different time frame that like that's irrelevant. The daily time frame, it doesn't really matter. Like the daily time frame happens whenever, either by the close or like whatever. Like most of the time on daily time frame, aside from this one, you're operating on like a price, not specifically like a time. So like price you can dictate ahead of time. Like for the swing, you can set an alert on just an entry, so it'll just, whenever it pings, you just got to be aware and like act on it. Yeah, sometimes these things like take off like right after, like those wick right through the channel and then back up, and you're just like, well shit, I missed that one. And like the higher it gets, like the farther away it gets from the channel's like band, like you can enter, but like you're just increasing your risk because you're closer to the stop than you are to, I mean, you're closer to the target than you are to the stop. So like, yeah, you can take a delayed entry, but like you're just adding more risk.
Yeah, and then for back to the STC, when you do take a trade, I don't know, let's say like on a daily, did you say you were doing this in connection with the weekly, or are you doing this in connection with the 2 hour? Like you always say, like like look at the 20 and the 2 hour if they're similar, good setup, right? So is there a similar strategy for using the STC, or when using the STC?
It was like we were talking about just a second ago. Like I would like to have confluence with the higher time frame, but this one is not. I know in the newsletter I talk a lot about like precision entries, and that's using like a smaller time frame to enter into a higher time frame signal. So like if I do get that daily chart signal, it's not going to let me move this to a non-snapped place. Got to turn that off real quick. So like I get an entry signal like right there on that day. Let's do a vertical well, just so I can, it's easier. Let's say I want a precision entry on a daily chart signal. I'd be looking for a 2 hour entry condition in line with the same thing. So like right here was, nope, not right here. Where is it at? Where did my line go? What's going on? Sorry, let me check. So move this forward some. Right there was when the daily chart touched the band on the daily time frame. This is going to be like the channel here is irrelevant because like it's not relative to the daily time frame. So like kind of ignore this right here. So like if I had the daily chart enter into the channel like and touch the bottom band right here, and I want like a precision entry, then I'd be using the next time frame down. For me, I like the 2 hour as a precision entry into the daily. So I would go to the 2 hour time frame and look for a concurrent or confluent entry signal. And that didn't happen here because it's showing that we're in like a bearish trend with a strong bearish like swing signal. So like I wouldn't, like maybe I don't enter yet until I see a bullish trend and a bullish swing entry signal. So like it's coincidentally, it's going to work out to be the exact same price roundabout, because like we'd be entering on the bottom band, and like by the time price gets down here, it's probably going to be about the same level. So like I would be entering around the same price, except during that time, like this entry here would have already hit the target and would have been out. It doesn't necessarily help to take the precision entries on these because it's really just about like the strength of the trend and like how quickly these are going to be moving at times, because like you're waiting for a retracement. Like it's really all about waiting for the retracement, and a retracement on a daily time frame in this context will mean a bearish trend on a smaller time frame. So like you're not going to get like the confluence that you want on like for a precision entry on this particular method.
Sorry, one more question. Like so with with the CSM, you say like you sort of like divide it up into batches, right? And like especially like you do like first batch, second batch. Usually I think you always say like second one is the one that you usually take. Is there...
Well, after an extreme move in a direction, yeah, the second one is generally the better one.
So is there sort of like the same strategy with the STC, or is that just what you use the ACT filter for?
So yeah, that's what the ACT filter is for. And the only sort of anecdotal and slightly statistical like thing to pay attention to is like continuity in these signal, or not continuity, concurrent signals. The more signals you get, the less likely that they're going to succeed. So like ideally you're wanting like the first two, maybe the first three like strong signals. After that point, you start seeing some falling off in the back testing. So like after like 4 or 5, like the fourth ones are less likely to succeed than the third ones are likely to succeed, and the second ones are less likely to succeed than the third ones, and the first ones are like more likely to succeed than the second ones. So like the more stacking on of a trend, then like the later you are to that move, so like they're probably going to be a little bit less profit, and you are assuming a little bit more risk.
And you're talking consecutive, right?
Yes,
like
consecutive signals. Yeah, so
Okay.
like this would be the first signal, this would be the second signal, and then you
Right.
would reset the count because like
Right.
you switch to a bearish trend there.
There's a bunch of signals right there, like 3 after another. Yeah.
Yeah, so like first one hit, it didn't get the entry, but like it led to a trend. Second one hit entry, then you have like no third signal. Like you have the second one like sort of confirming that you're still in the same situation, like the same trend, but you don't get the entry signal, and everything fell out from there. Let me see if I can find. Okay, here's a good one. First signal, entry, exit. Second signal, really close to an entry but didn't hit, would have been an exit. Third signal, entry, exit, then turned out the other way. Like this is pretty like similar to like most things. Like here we go, bearish trend. There's a long one. Wow. All right, one signal, enter, exit. One second signal, entry, probably would have been stopped out. Third signal, entry, probably would have been stopped out. First signal, well, no, it still would have been fourth signal, fifth signal, second, but yeah, I mean, it's just mathematically after the third, you're getting less likely to make it, because trends only last for like so long. This is also intraday, so it's like not going to be all over the place.
Sorry, I just came in on the tail end of something that you were just saying there. Did you say that after a strong reversal, you would wait for the second signal?
No, that was in the context of the CSM, like when we were talking about batching the signals together.
Oh, okay.
Yeah.
So in a situation with like where you are right now to the left, this has gone essentially from bullish and then straight into bearish. Would that first signal be something that you'd look at taking?
Nope. Well, okay. So I just lost this shot. Where was it?
Yeah, there.
Okay, so this signal right here, we're in a bearish trend, flip to a bullish trend here, got the strong signal to enter there. You would have been entered right here and exit right there. So you didn't have any more entry conditions after that.
Okay. No, but then you flip to bearish. Like, would you be like, oh yeah, that's cool. I can wait till this hits the candle to the right where it does hit the yellow and then come down because you've got a strong bear flag. You'd be like, oh yeah, that's cool. I can do that. Is there a situation where you wouldn't take that first?
No, because it's all about the filter. Like mathematically, this is like, yep, this is good. And then your trend is being confirmed or your trend strength is being confirmed by the ACT. So like, there's no reason not to take it.
Cool.
And like it hit the entry and target in the same candle.
Yeah, I mean, that's super helpful because I did struggle with, I started doing well with this and then I lost it. So I must have been overthinking it, but this has made it a lot more digestible.
When I first brought this script out, I don't remember if I had the CMO finished at the time. Like I think it was still like, because I remember like this is a second iteration of this script. Like I don't remember who had access to what because I've been around for long. This was the first iteration of this script where it had the EMA or VIDIA, and there was a lot more dots involved.
Yeah.
And then the second iteration is this one that everyone has access to right now. Let me turn this guy off, where it's a lot less dots and stuff like that. And the next iteration that everyone will have access to pretty soon keeps the same sort of dot pattern, except we have the trend, like just a trend line like plotted out on the bottom.
Cool.
And I don't know where I want to put that or like how I want to display it, but like it's just like a quick visual cue of like, oh yeah, we're bullish trend now, or we're in bearish trend kind of thing. And this one will also have, like, I don't have it on the chart right now, but it'll have like the entries, that kind of stuff, the take profits and levels on there and stuff like that. So like this would have been an entry, that would be your first target. Like the band would be your first target. This is your stop loss, and it didn't close below, so you weren't stopped out. It would have been hairy as fuck. You would have been sweating balls, but then it swings back up and smashes your profit target right there. So yeah.
Did you make, this is going to be a stupid question, but did you make this up, like based on
No, like I said that at the very, very beginning, but I guess there's a trader called Jake Bernstein designed the moving average channel, but actually I don't know that it's his idea originally. I mean, nothing is no one's making anything new. Like everything is just a rehash of something else. And this is his, from as far back as I can research, like this is his brainchild. But I've modified it slightly just the same way, like the RSI, the cyclic RSI, like that was someone else's idea. And I just like modified it to suit, how I saw errors, not really errors, but like just implementation, a different implementation that like fit really in my style and made more sense to me.
Cool.
Like and one thing I dislike about the original version was literally it's just like very just like rigid, and like there's no room for any sort of discretion. It's like that's not useful. I mean, yes, it'll work, but like you can't really determine, like, there's no sort of like after action reporting that you can do. It's just like this one lost, this one won, this one lost, this one won, and you're just like very much playing the numbers, which is fine, but like it's helpful to like see this type of thing. It's like this one lost, and like, okay, there's like some more context to that. Like it lost and there was also no trend. So if I would have noticed that there was no trend beforehand, like I wouldn't have taken that trade, right?
Sure.
Or if there wasn't any trend strength, like I wouldn't have taken that trade, because like, why do I just want to sit here waiting forever for my profit?
And then direction up or down is not a thing for the ACT. It's just position in relation to the 30 and the 60. Higher is stronger, lower is weaker, but directionality is nothing.
Nothing.
See, that's what confused me before, even though you and I have been through this previously, like a while ago.
Mm-hmm.
It made sense, but it didn't make sense about directionality and strength. How it kind of is a lot clearer. It's just a matter of a measure of strength from 30 to 60, but who cares? Doesn't matter which way.
Yeah, because like these like the thing that's difficult and really important to like get behind, like that type of thinking, like getting away from like the directionality. It's like this is really hard, and like also not necessarily this, but let me go back one. Like this area is really hard because like what does that mean? Like it means there's not a lot of trending direction. So even though, or like there's not a lot of trend strength, but even though prices are like pretty consistently going down, you're like, well, like what does that mean? Like I don't know what to do with this. Like it's bottomed right there and it started going up. And like the thing is, since there is no bullish or bearish intention in this particular math, like we don't know that the bearish moment, we don't know if it's bearish strength that is increasing or bullish strength that is increasing. So like that's why it's difficult to just like wait until we're in a strong trending condition on the ACT, because by that time you'll more than likely have some sort of other signal like telling you, oh yeah, we're in a bear trend or we're in a bull trend, and like right here we're breaching above the 30 line and we're still in bullish conditions based on or bearish conditions based on the moving average channel and Williams accumulation. So like it's like, okay, cool, I am perfectly fine taking the short from right here because we have a bearish we have a strong trend while we have a strong like CMO trend strength while we're in a bearish trend. So like I can take this bearish entry, hits its target either there. I don't know. I can't really tell.
Okay. No, that's good. That makes a lot of sense. That's good. Look at that. Learning all day learning.
So I'm just looking at the daily for BTC, and like the ACT goes above the 60 on the 24th, like Saturday, something like that. And it just stays up there, and it's just it basically resembles sort of the same thing as it does 30 and below.
What do you mean?
It's like just sideways.
That just means like, so like this is a measure of trend strength, and it's not really, again, like we were saying earlier, it's not about the directionality. Like it's just like it's just like a volume level. Like when you turn the volume up, you're not really thinking about like the circular motion of like your knob, or like how the volume is like increasing on your like histogram or whatever, getting bigger and bigger and bigger and bigger. It's just at a level. Like it is just, you just have a strong trend. Just because you have a strong trend doesn't mean price is going up. It just means that like you have a strong trend. Like that's it.
Okay.
Like volume being at 10 doesn't mean that it's just going to get louder and louder and louder. It just means like you're now here at volume level 10.
So and when it's above 65 for a continued period of time, is it fair to expect a decline afterwards, like a stronger one? No.
So no,
actually,
like I put that line on there because it's the way traders think. Like it's a familiar like indication, like an overbought in air quotes level. And like statistically, you can see that like there are very few times that the ACT measures above that level. So like this would be an extremely strong trend. And like you need to be careful, like you need to consider things a bit more when you're in extreme conditions. Do they work? Like, do they still work out? Sure. Like prices can continue trading overbought like for forever. Like it doesn't really like, it doesn't matter. But it's just something to keep in mind. Like if this is an extreme measurement, like it's probably not going to be up there for a while. But like, again, we're not concerning ourselves with the directionality of it. It's just like a little bit of extra context. Like maybe we'll be losing trend strength at some point in time because now we've started trading at extreme levels.
Right.
But again, you can have declining trend strength, but have prices still go up and have prices hit their target.
So from what I'm looking at, it feels like that area between 30 and 60, when there's, I guess, directionality, if you will, like going up or going down, that's where most of the price action up or down will happen.
I don't know. Like that's not like it. I have no idea. Like it's really it's really just about being above. It's like think of it like sort of like the midline on the RSI. Like being above the 50 means you have bullish pressure. Being below the 50 means you have bearish pressure on prices. Like that's where the influence will be. So like being above the 30 means you have like a strong trend, and being below the 30 means you have like a weak or an inconsistent trend. Like that's it. Like you don't need to look any further into it. And like once you're above 60, you have an extremely strong trend. It's just maybe if like let's say we have, let me see if I can find an example of one. So like right here, that do not do this, but I'm making an example. Like if we have this signal, like let me see if I can find a place in the past. This is probably not going to work. But okay, cool. So let's take this right there. So this is drawing a price level on what was like this resistance right before we broke above and like went crazy up for forever, 20k roundabout there. So like when we got to that place again right over here, when we got to that place right there, when price touched that level again, which it hadn't touched for years, like we were measuring a strong, like an extremely bearish trend. This is just from an analytical standpoint, not necessarily a trading standpoint. Like if we're in an extremely bearish trend, like when we get to this support, like this is going to give me like it'll give me an alternating view. Like one, I'm going to be cautious of signals that are telling me that we're going to break down from this level, because we're already in like this extreme trend. And like, where else are we going to go from there? Like if we're at the support, once we're already in an extreme, like I would be more interested in a signal, an entry signal coming in after we've broken down that level, because that would like this would probably not be the short signal that I would like want to take, because at extreme levels, we didn't like at an extreme trend, we couldn't break through like that support like we couldn't like break through that support. So like maybe I'm not going to take this one because like, well, actually it didn't make a difference because like the trend strength started declining.
But like by the books, yeah, you would be taking this trade. But like thinking in my head and analytically, like I don't think we're going to be breaking down from this because like we're already at an extreme and supports have been holding. So it's like, do I think we'll have like this has to like it only has so high it can go. It can only go to 100. Like, yes, it can stay there for forever. If an extreme reading isn't breaking support, maybe it won't, you know. But that's just like an analytical like context. It's not like the trading context. The trading context is literally just like, is it above 30 or is it below 30? And like that's it. Like the RSI, it's the same thing. You can put in tons and tons and tons of like analytical like context, but like it doesn't, it's just like to think on. It's not really like the trading setup. You either trade the setup or you don't based off of like XYZ, because we can think and create all sorts of scenarios that like all they're going to do is just keep you out of trade. It's like here again, another bearish, strong bearish signal. ACT is at like the extremes, and like we're measuring an extreme bearish trend, yet it still didn't break like the support and like bounced right off and just like flew back up. It's just like extremes, you can't continue in extremes for forever, because like, well, I mean, I said that you can't have like plus extremes for forever, because then it wouldn't be an extreme anymore. Like it's something that's going to like return back up, you know, back under. So like being at resistance while you're measuring an extreme bullish trend, or being at support and measuring an extreme bearish trend, is like not really the greatest thing in support of like getting through that level.
Yeah. So on the daily, then having support and resistance added to it would actually really help, especially the very strong ones that define months or years even.
Say that one more time.
So having SNRs on lines on the chart. With using this would actually be super helpful, because it will, as you just explained, give you an indication of, okay, this is a bounce probably for the first time. It's going to retest it, and then we'll see if it's going to retest again or not, or if it's actually going to break down.
And like analytically, yes, like going the same direction. We're already at this extreme move, and we haven't been able to break like the resistance level. So like that doesn't lend a lot of analytical weight into breaking through the level. So my risk of failure is increasing, and my like the risk of failing from this level is higher than it is from breaking through the level, just looking at this chart. But trading the method by itself, like I'm still taking the entry, because like it's still above 30, and price will if price comes down and touches the bottom band and this is still above 30, I'm still going to take the entry, because that's the system. And like analytically looking at support and resistance, it doesn't matter, because like all the back testing is not considering support and resistance. So like by the math, it works without thinking about that. So don't worry about it. And even so, if analytically this is not telling me, but like it's making me suspect that this level will fail, I don't really care about being wrong in that point. Like if this fails, the channel's pretty small, I don't have a lot of risk in it. But if it's right, then I'm blasting through this level that's been held for over a year, and we're in like price discovery basically. So like I'm okay with my analysis being wrong and the system being right. That's, if anything, that's one reason why I would like not really worry about the analysis, because like fuck it, like if this is right, then it's going to be a really good right. Analysis is really just for like creating some sort of story, and like I'm not trading stories, I'm trading signals and systems, because I can make a story to present any sort of idea that I want. Like there's enough technical factors out there to support any sort of idea, and that's not really enough. That's the hard part for some people sometimes, to like look at analysis and like make a trade decision based off of analysis, because like you can make any sort of analysis and like support any idea. So like it's really about the systems more than the analysis, because that's why you have people that are really good analysts but like garbage traders, because like it's not really about the analysis.
The analysis tends to be biased usually, unless you're kind of like a robot. I mean, if I look at the sideways thing, like I feel like I'm trading against algorithms like 99% of the time, because I'm looking at it and I was like, okay, that makes sense, and then like 10 minutes later I'm like, oh fuck, that just didn't work out at all.
On the indicator on mine, I have arrows pointing to entries. Did you just turn them off in settings?
Yeah. Yeah.
And then the other thing too is you also had the CMOS as part of this.
No, the ACT was the only one that was a part of it.
Okay.
The CMOs, I wrote them at the same time, and I provided a couple examples of like if you wanted to use a little bit more like precision, you can use the CMOs, but really it's just about the ACT. Like the CMOs is honestly, I think it's only really useful for like scalping on really small time frames, because it's like it's really just like it's not a good leading indicator, it's a good in time indicator. Like it's telling you what momentum is literally doing right this second. So like when you're scalping or whatever, like that picture of momentum is like really good for like getting out at the like last moment of like some, you know, minute long candle or whatever. It's really a faster sort of indication. It's not great. I think
What
I'll
would
put that in chat
what
too.
would
Like
be-
it's not great for like future sort of analysis.
Well, so then would it be like not necessarily useful on an hour time frame or anything below an hour, or like how fast? Because obviously,
you're scalping, so like I would say anything like under 20 minutes, but probably ideally under like the 10.
Okay.
You know, like the
and that makes sense.
five,
Yeah.
5, 3, 1, like something like that.
Makes sense. Okay, cool. No, that's good. That's super helpful.
Did we do a separate call for scalping?
No, because I would probably be extremely rusty at that, and I think it's
Still
more
500
beneficial.
times ahead of me.
I think
No
it's
matter how you are.
like this is like a bias I have, but like playing higher time frames on better signals is more profitable than scalping. So
Yeah.
it's like time. I've done the math on like a couple different systems that are scalping systems, and like my normal like just a daily chart CSM signal. And like over time, the profit per like minute of work is higher on the longer time frame signals, the higher time frame signals. So like if I can get the same profit for less time requirement, I'm gonna do that. Kudos to all, like, you know, cheers to all the scalpers or whatever, but like fuck that. Yeah. It's just like, you know, I value that's where my values lie. My values lie more on my time to do other things than to stare at the chart for like 5 hours waiting or scalping. And like the intensity, like it was cool when I first started, like the intensity was like really fun and like it was a rush and whatever, but it's like that
It's only fun if
just-
it's trending.
it's draining to me, like
Oh yeah,
to
oh my
do
god,
that,
the last
so-
2 weeks have been horrible.
So I wouldn't have a call. Like I'm not the person to like have a conversation about that. Like, I mean, maybe some point in time when like the market's like super popping, we can like do something like that, because there's then the value add swings towards the scalping side. Like when everything's literally flying, like it's the time to like do that, you know, trade off the 5-minute, 10-minute chart or something like that, and like catch, you know, these crazy moves. Yeah, no problem, Brett. Like there is a time for that, but for the most of the time, that's like not true. An hour and a half. Any other questions on the indicator?
Not at the moment. I think I'll ask a lot.
Cool. I will get the recording downloaded. I don't think I really need to do much editing on this one, so I'll pop it up in the chat either later today or tomorrow. And whenever I get the new version of this finished up, I'll have that out to everybody. But yeah, thanks for hanging out and asking questions. Well, thanks for coming around. I will chat with you guys in chat and whatever.